1 year ago today, the United States of America lost its last AAA credit rating. Moody's, the final holdout of the three major agencies, downgraded American debt. May 16th, 2025. It was truly historic. It was alarming, and within about 48 hours, everyone had moved on. Back to the news cycle, back to the scroll, back to pretending that the world's largest economy quietly admitting it can't be trusted with its own credit rating was just another Tuesday. But here's what nobody actually told you. The consequences of that very downgrade, they weren't going to arrive immediately. They never do. They arrive slowly, structurally, silently, painfully, in your mortgage renewal, in your grocery bill, in your pension statement, in the number in your bank account that keeps being worth slightly less than you ever expected. They arrive exactly 1 year later, which is right now. And the people who should be warning you about it, where are they? They're still on the yacht. So here's the question nobody is asking you, but absolutely should be. What actually happens in a year after the world's most powerful economy gets downgraded? Not the day of, not the headlines, not the 48-hour panic. What happens in the quiet 12 months that follow? When the cameras have moved on, when the politicians have probably changed the subject, and the consequences are working their way through the pipes into your actual life. That's what we're going to talk about today. And before you reach for the off button, I want you to stay, because by the end of this video, you're going to understand something that most people spend their entire lives not knowing. I'm going to call it the debt trap. Say it with me. The debt trap. It's not conspiracy. It's not hubbubaloo. It's pure mathematics. Undeniable reality. Not fictitious, unfortunately. And unlike politicians, mathematics don't lie. And unlike credit ratings, it doesn't take a year to notice. Now, before you ask, who am I telling you this? Who's this random bloke? Well, it's a fair question. I've spent 25 years in financial markets. I've interned at some of the biggest banks in the city of London, which is basically Wall Street, but with worse weather and better sarcasm. I've worked on trading floors where the people make decisions that affect your savings, your mortgage, your grocery bill. We're making those decisions in rooms you will probably never be allowed into. And what I learned after 2.5 decades in these financial markets is this. When something unimaginable is before you, about to happen to the economy, they already know it. It's just that you don't. And when it happens, they quietly reposition, they hedge, they move the money, and then they wait for everyone else to catch up to the reality they've been sitting on for months. And now, you're catching up. Finally, this is what's happening. So here's exactly what you're going to understand by the end of this video. Step 1, we're going to revisit last year's Moody's downgrade, not as history, but as architecture. We're going to understand it because understanding what that downgrade built, the structure it created, is the only way to understand what's actually happening in your finances right now, in May 2026, in June, July, August, September, October of this year. We're going to be talking about the squeeze that you're undoubtedly feeling, the invisible hand stealing out of your wallet, the one that's been slowly, quietly, surgically removing money from your life while telling you that inflation is under control. And there's step 3 and there's step 4. But you're going to really want to stick around for step 4 because it's where everything really gets real, unlike that catch. But hey, let's go. Let's get this ball rolling. But here's the thing, and this is why I need you to watch until the very end. The debt trap isn't just about governments. It's about you. It's about your mortgage, your pension, your children's future, your inability to afford a house that your parents bought for the price of a decent holiday. The debt trap is the single mechanism, the loop that connects what happened to the US credit rating a year ago directly to your cost of living today, right now, to the wealth that the top percent are accruing, your shrinking purchasing power right now in 2026. It's all one thing, one chain. And when you see the chain, you can't unsee the chain. So do not go anywhere. Hello, welcome back, my financially disobedient, quietly panicking, curious capitalist, socialist, or wherever otherist you may be. Let's talk about what happened precisely a year ago, and more importantly, what it's done since then. Moody's, one of the three most powerful rating agencies on earth, downgraded United States debt from AAA to AA1. That was the first time Moody's had ever done this, and combined with S&P's downgrade in 2011 and Fitch's downgrade in 2023, that moment in May 2025 made it official. All three major rating agencies no longer rated America as the gold standard, which is a bit like finding out your most responsible friend, the one who always paid their half of the restaurant bill, remembered everyone's birthday and had a pension at, like 24, has been secretly maxing out their credit cards and crying in a Waitrose car park. Now, Waitrose is a very expensive supermarket chain in the United Kingdom. So I guess that would make more sense if you were from the United Kingdom. But nonetheless, all those things are devastating. Mentally, financially, economically, socially. But also, honestly, we all saw the signs. But here's the bit that gets me. And I mean, it really gets me. When the downgrade actually landed, the initial reaction was markets wobbled, politicians blustered, commentators commented, and then the news cycle ate it all up. People went back to normal, carried on. They assumed that because there wasn't an immediate explosion, that there wasn't really a real problem. But we all know that that's not how debt actually works. When America's credit rating drops, it doesn't punch you in the face immediately. It quietly, methodically increases the price of everything. Think of it like your credit score dropping. Suddenly your mortgage rate goes up. Not dramatically, not all at once, but just persistently. Your overdraft gets more expensive. The whole cost of your financial life inflates. Now, scale that to the world's largest economy and think about the US debt payments and the interest on the payments. We're eating 9% of all government revenue when Moody's made that call. Moody's themselves projected that the number would hit 30% by 2035. 1/3 of every dollar in the US government and what they collect gone. Before a single road is fixed, before a single hospital bed gets paid for, before one teacher gets a raise. And in the 12 months since that downgrade, the borrowing hasn't slowed down. The spending hasn't stopped. The debt hasn't gone anywhere except up, up, up. And yet somehow you were supposed to have moved on by now. You were supposed to be richer by now. So, let's just do the numbers, the raw hard numbers, because the numbers are the point. Now, the US national debt is currently somewhere in the region of, and I want you to sit down and digest this, $39 trillion. And that's just the funded liabilities. I'm not talking about the hundreds of trillions in unfunded liabilities like pensions and obligations and other readjustments that they haven't actually provisioned for. That's a number so large, it stopped being real about $30 trillion ago. But here's what changed in the year since the downgrade. Moody's projected that US federal debt could hit 135% of GDP by 2035, up from 98%, which was already, I think you'd agree, eye-watering and unsustainable. Now, for context, when debt exceeds 100% of GDP, economists start using the word unsustainable. And when it hits 130%, they start using the word structural collapse in very hushed tones over very expensive coffee. And at 138%, they apparently just update their LinkedIn profiles to moved to Switzerland and gave up. We're not at the 135% yet, but we're on that road and you can see the signs. Now, you might be forgiven for thinking, okay, big numbers, cool. Government problem, happened last year, nothing's really happening now, so it's not really my problem. Oh my friend, my dear friend, oh no, that's not how it works. You feel it already, don't you? We all know that when you do your weekly shop and you pause at the milk or the cheese or the bread, when you see your mortgage renewal letter and your stomach absolutely drops, when you look at your payslip and then you look at your rent, and then you do a little calculation in your head that makes you want to sit down very quietly in a dark room. That feeling has a name. It's called getting squeezed. And it is direct, it's measurable. It's a documented consequence of 12 months of a downgraded economy working its way through your daily existence. And here's the data, the raw hard data. For 80% of us in the developed world, I'm talking the Americas, the Europes, the Australias, over the last 6 years, overall spending hasn't outpaced inflation, which means in real terms, you are buggered. No. In real terms, your purchasing power hasn't improved. You are running on a treadmill that keeps getting faster, and the downgrade just quietly turned up the speed, increased the gradient, and put some weights on your ankles. Now, non-housing household debt in the US has hit $5 trillion. Consumer credit, auto loans, student loans, medical bills, the invisible scaffolding of a life that costs more than it should. And meanwhile, what's your government doing? They're introducing tariffs, and they've typically cost people in the developed world about $1,500 or £1,300 this year so far. $1,500 just gone, not because of your choices, because of a trade war you weren't even consulted on. You didn't even know it. You didn't even get to vote on it. Laid on top of that, the debt spiral you didn't vote for, built on the ruins of a credit rating nobody told you was crumbling. And yet, when you feel financially anxious, you're told that everything is okay. And the narrative is that you're bad with money, that you need to cut down, that you need to prioritize. Now, all of that sounds laughable, but let me introduce you to the most important funny letter of the alphabet right now. It's not an A, it's not a B, it's not a C, it's a K. Yes, the K-shaped economy. Picture the letter K. One arm goes up, the other arm goes down. And the top arm, that's the wealthiest 20% of us. Their wealth has surged. Our wealth has surged if you've had investments, if you are one of the lucky few to have positioned properly and listened to channels like these. The bottom arm, now that's everyone else. Costs up, wages stagnant in real terms, opportunities narrowing, debt rising, mobility going down, and the higher the borrowing cost triggered by a year of downgrades last year. That's the burden that the working people have to carry. And here's the number that should keep you awake at night. The top 1% of Americans carry 31% of all of the wealth. The bottom 50% obviously own the rest of it, right? No, obviously not. They only own 1.5 to 2.5%. 2.5%. Half the country is sharing 2.5% of the wealth in the world's richest nation. In 2026, after decades of economic growth, after a downgraded economy was supposed to be the wake-up call, after a squeeze that's been running for 6 months straight, all of the inequalities by every single measure is up. Before we apparently learned anything, we're repeating the same mistakes again. I hate to break it to you, but the debt trap isn't by accident. It's not even new. It's a system that has been running for years and years, that got a very loud warning siren 12 months ago, and it said, hey, let's just keep running up. And understanding the system is the first step to not being consumed by it, obviously. So a year on from the downgrade, where does this leave us? Well, let me give you the current numbers. Right now, Moody's Analytics predicts the probability of a US recession in the next 12 months at 50%. Goldman Sachs are saying 40%, Wilmington Trust are saying 45%, and the legendary economist Gary Shilling, unless you don't know him, he called the 1969 recession, says a downturn is, quote, almost inevitable. Almost inevitable. Now, those aren't fringe voices. Those are the institutions that manage trillions of dollars in assets. And when they say almost inevitable, what they really mean is they're already repositioning. They're already hedging. They're already doing what they're paid to do. And before you answer, the US economy lost 92 1,000 jobs in February this year alone. Manufacturing employment has declined by 90,000 since Liberation Day was meant to liberate us. The housing market has entered what economists are now calling its own little micro recession. And small business confidence is at its lowest level since 2020. Just ask any of these poor, lamentable, poor little business owners. These aren't projections, these aren't warnings, these aren't receipts. 1 year later, exactly like the downgrade said it would be. But sure, the economy is strong, totally fine. Nothing to see here. Move all along. I could end this video by telling you that everything's going to be fine. But I'd be lying to you, and you deserve better than that. What I can tell you is this: the people who navigate economic disruption best are not the ones with vast amounts of money or the most money. They're the ones with the most clarity, the sober understanding that's not myopic. They are the ones who looked at the system, really looked at it, and decided what was the forest for the trees, to understand it rather than wait for someone else to explain it to you 2 years from going on. That's you, right now. You've sat through, I don't know how many minutes of this video you have sat through, hopefully, and you've heard the economic reality that most people just scrolled on by. Whether you're a capitalist, a socialist, or any other kind of ist, financially disobedient is the best possible way to be. And if this video made something for you click, then give me a click and subscribe. No, I'm joking. I mean, only if you feel. No, actually, subscribe. Share it with the person you think in your life deserves to understand what's actually going on in their life. And if you want to go any deeper on this, the links and the sources are in the description below. Stay curious, stay disobedient, stay clear, and maybe, just maybe, stop trusting those guys on the yachts. I don't know, just my piece of advice. Ciao for now.
As the clock clearly demonstrates, the current fiscal trajectory is unsustainable.
We anticipate a down.
It was the ticking that captured the attention of the city, a stark reminder of the nation's rapidly expanding debt, soon reaching into the trillions.
Gentlemen, this chart clearly demonstrates the severe risk of the current administration's borrowing. These piles represent the future obligations of the American government. It is a staggering sum.
The risk assessment looks solid on these tranches.
Yes, the underlying assets are strong. I concur with the AAA rating.